as we talk. So let's kick this off. So welcome, guys, to the AladdinDAO and BanklessDAO co-hosted research meeting. And today we will have Tom Kearney. Tom is founder of Echo Capital. He is ex-Coinbase and has been a very supportive Boule member and also contributor at AladdinDAO. And today he will present Lido and also share some insight on Ethereum POS and the role of staking derivatives will play. So I will pass it to Tom.
Cool. Thank you, Charlene. Let me just pull up my presentation here. I'm going to lower the frame rate, so hopefully it's like loads faster. Cool. Yeah. So everybody can see that.
Yep. Yeah. It all looks good. It was
okay.
Quick.
Yep.
Cool. Perfect. So yeah, as Charlene said, my name is Tom Kearney. I run a venture capital, basically, firm called Echo Capital. And I'm also a AladdinDAO Boule member. So yeah, I wanted to present on Lido finance, and sort of that discussion naturally leads into some bigger topics. This is going to be somewhat of an exploration of like how Lido works, but it's fairly simple, and it's kind of more about the merge and sort of like bigger picture stuff around the future of Ethereum and sort of some of the like particularities related to the situation with Lido and how I see that changing after the merge and how most people see that changing after the merge, as Ethereum obviously becomes proof of stake and staking plays a much larger role in how the whole system works. And so it'll be like a bit more of like a broad presentation, but I also do think that I personally have, I think there's some actionable sort of parts of this. So of course, classic, this is not financial advice. Do your own research. I really think, especially related to this, like I think if you're interested in Ethereum and sort of like part of the community, I think this is particularly something to be aware of. And but I do hold LDO and Steth, and so does Echo Capital, the firm I run. So that is just also take everything with a grain of salt. So yeah, as I mentioned, we're going to go into a couple different sort of parts of this whole question. Talk about proof of stake and what staking derivatives are, or liquid staking is. Talk about some specifics related to Lido. Talk about the merge. Talk about sort of the debate and I guess just sort of the conversation that's ongoing around Lido and staking. And hopefully by that point, you guys will have a little bit of like sort of both sides of the argument and can decide for yourselves. So Ethereum, the beacon chain staking, it has some sort of natural like drawbacks. So first of all, you can only run a validator with multiples of 32 ETH. So the minimum's 32, and that's obviously like multiple tens of thousands of dollars, which is expensive for your kind of average person. And additionally, there's like a lot of considerations to running a validator node and being a block proposer. One is just sort of like the running of the operation, and then sort of hand in hand with that is if you do that poorly, you can get slashed, meaning your Ethereum that you're staking can get burned, if you are perceived as acting in bad faith. by the system, which sometimes can be as simple as just you lost connectivity, your internet connection went down. So there's kind of, you really don't want to mess it up. And then, of course, there's the opportunity cost. If your ETH is locked, you can't use it for DeFi or for fees, for smart contract development or buying NFTs or what have you. So there's an opportunity cost there. So the idea of liquid staking sort of evolved to solve for some of these problems. The basic idea is that you give your ETH to a contract, and that, or basically to a validator who stakes it for you. You are given a derivative token that represents basically like a claim on that ETH that you locked. And then there's some split of the staking rewards that accumulate to, for that ETH that you've locked up. So you get a token without having to run a validator operation, and you pay a fee basically to the person who's handling that for you. So that's what Lido is. You deposit 1 ETH and 1 ST-ETH or staked ETH is minted. Lido is. Sorry. Was someone say something? Oh, sorry. I just heard someone's voice in my headset. Yeah, Lido has like a set of node operators. And I think the eventual goal is to reach like 100 of these independent parties. And these are the validators basically. So yeah, this is a little diagram of how this all kind of works. So Lido's liquid derivative, which is called ST-ETH, recently kind of like has got some attention for losing its peg, which is sort of like it doesn't really have a peg right now. And there's some reasons, like I think it's helpful, and we'll talk about like that this is just sort of like a risk of interacting with this system in, I would say, the next like probably year is there's not going to be a peg. And we'll talk about like why there's not going to be a peg, but so or there's sort of a one-way peg. It can trade below the price of ETH. It won't trade above the price of ETH for an extended period of time. But yeah, so just kind of talking about like some of the different pressures that are acting on ST-ETH compared to ETH. Like you might consider ST-ETH a more valuable asset, because we talked about it's like this rebasing yield accumulating asset. So basically you are earning interest based on the staking rate directly to that asset. So that's very like interesting for DeFi applications, etc. There is the downward pressure, I would say, of like the smart contract risk. So Lido's contracts could get hacked. So that's sort of like a reason to price it lower than ETH. I think also like there are these specific, because they are like separate assets, there can be these like siloed effects or events. So for instance, like during the Celsius and Three Arrows Capital insolvency crisis, there was a lot of forced selling of various assets, and both those groups held a lot of ST-ETH. So you can have these sort of weird events that end up like just forcing the price of ST-ETH down. Yeah, specifically, I also wanted to talk about there's this there can be a lot of leverage that builds up specifically around ST-ETH. There is, the other side of that is like ETH can be over leveraged as well. But for instance, there was, because of the yield generation of STETH, there is a bit more pressure to, like, people are building these like leveraged vaults that will basically swap ETH for STETH, borrow against that STETH for more ETH, swap it for STETH, and do that some number of times. And depending how much you do that, you can become over leveraged in that, like in the system broadly, depending on how many people do that. And so for a while there was like when the STETH ETH peg was first starting to kind of slip, people were really worried about specifically this like one InstaDApp vault that had a lot of leverage in it. And basically, I think if the price of one STETH went below like 0.9, maybe 0.9 or something, there was going to be a lot of liquidations, which could potentially like really crash the STETH price. So, I mean, but that's also, it's something to keep in mind if you do your research and you are confident in the Lido smart contracts and you want to be long ETH. The eventual thing that is, supposed to happen is post merge and post the Shanghai hard fork in Ethereum, you will be able to withdraw ETH for each STETH. So it's something to monitor, and if you do think that smart contract risk is minimal, it can be a way to build your ETH position at a discount. So, and eventually there will be a two-way arbitrage. So right now, if STETH trades above 1 ETH, you can buy ETH, put it in the Lido contract, and pull out STETH, which is worth more, and sell it. So you can arbitrage that way, which will bring the price down to 1 ETH. And eventually, when you can withdraw, similarly, if STETH trades below, you can buy it STETH for cheap, pull out of the Lido contract for ETH, which is worth more, and sell it for an arbitrage profit. So once withdrawals are enabled, there should be a pretty clear one-to-one peg, in the same way that there is for like Tether and USDC. This is just a graph of what the peg has looked like. So you can see, like, in the last sort of month or 2 months, it has gotten more sort of drastically off peg. So definitely it's something to think about and consider and be aware of, like I mentioned specifically, like kind of leverage in the system and what that could possibly do to the ratio. So yeah, the other part of Lido, so we talked about STETH a bit. The other part is the LDO token. So the main tokenomic thing here is just that 10% of all staking rewards from all ETH that are being staked on the platform are taken as a fee. And so half of that goes to node operators and half of that goes to the DAO treasury. And there's also like a slashing insurance pool that I think they are not adding to right now. I think potentially it's large enough that they don't feel that they have to. So right now it's just a even 5-5 split. So, but yeah, this is kind of a big deal, like that 5% of all staking rewards from ETH on the Lido platform go to the DAO treasury, which we'll see is a pretty large number. So the other thing that we're going to talk about more sort of like at the end is the like governance aspect of the LDO token, which has become kind of contentious. So certain things are like less contentious. You can change the fee structure of the platform and certain things about how the platform runs. Slightly more contentious, you can approve node operators and like change who is validating blocks. or proposing blocks. So this has like implications for MEV, and implications for kind of Ethereum broadly in the new proof of stake model. So something to talk about here is just how huge Lido is. So STETH, currently the number 13 token by market cap and number 5 ETH asset by market cap. It's like around $7 billion. So huge, and very widely integrated into like DeFi applications. There's like $1 billion Aave vault. There's the like $1 billion Curve pool. So extremely liquid. It makes up 90%, I think even a little bit more than 90% right now of the liquid staking market. And it's fully 30% of ETH staked on the Beacon chain right now. So really huge, really substantial part of like all staking activity on Ethereum. This is just the growth over time. As you can see, it's like there's some Rocket Pool is like, I would say, you know, it's a substantial piece, but really it's almost a complete monopoly by Lido. And interestingly, I thought this is sort of poorly labeled. You can't really tell what's what, but that 30.9%, that's Lido. And then sort of on the other side of the graph, that like green, blue, and red, 14, 8, and 6%, like that's Binance, Kraken, and Coinbase staking. So Lido's actually larger than all those 3 exchanges combined, which I thought was really interesting. So it's massive. It's really big, and sort of like there's reason to believe that this is going to continue to be the case. I think there's some debate about like to what extent, but definitely this type of product, because there's like, you know, this like liquidity begetting more liquidity effect, or like this like liquidity flywheel. It's a really hard thing to break, like this sort of network effects where if you have a larger liquidity, a larger amount of liquidity, like you're going to be the token that most DeFi protocols are going to want to integrate first and prioritize. And so you get integrated all across DeFi, and you get integrated earlier in new stuff. And then so when new people enter the system, they're naturally going to look at the landscape and say, oh, well, I should hold the thing that's most compatible with DeFi broadly. And then, you know, that increases the amount of liquidity across the whole system. And it's just sort of this self-reflexive, positive feedback loop. So, that's kind of, I mean, there's other reasons. The Lido team is really great and executing really well. So I think that's like another reason why they've gotten so big, but really like this is super powerful and it's so entrenched at this point. Also, I think mentioning just that, like in bear markets, people tend to want to be in the really liquid stuff because they want to be able to know that they're going to be able to move quickly. And so, yeah, this is kind of a classic thing when things get a bit more chaotic. People kind of go to like flee to like the safe assets. So I would argue that potentially this effect is actually even stronger in bear markets. So yeah, the merge is coming up. That's the total target difficulty. So when difficulty reaches that point, the merge will begin. This is supposed to happen like 3 weeks from now, which is pretty crazy considering just how long we've been kind of like waiting for a change to proof of stake. It's like many years of like talking about it, but it's kind of hard to believe that it actually has a date at this point. But yeah, assuming that it does happen, and I'm hopeful that it will. There's big changes, obviously. So Ethereum becomes proof of stake, and this, I think, is gonna. There's a lot of ways in which this is going to change what staking means. So, like, first of all, in the way that hash rate is directly related to the security of the Ethereum network now, the like staking ratio or like the total value staked becomes related to the security of the network. So there's going to be incentive to increase that at least to a certain point. Also, importantly, stakers are going to earn transaction fees, which there are a lot of them, and also MEV. So this is going to like sweeten the deal for protocols like Lido. There's going to be like a whole new source of revenue basically for people who are staking. Also, I think you're going to see more people that have been kind of waiting to just make sure that the merge goes off without a hitch, that then see that it does and feel comfortable then, entering the system and staking. So all these things I think add up to just like a much larger stake on Ethereum. Yeah, notably also here, this is from the ethereum.org website. So during the Shanghai upgrade, which is going to be, they say, at least 6 to 12 months following the merge. I've heard more on the 6-month timeline, but yeah, so assuming the merge happens in September, it could be until September 2023 before withdrawals of staked ETH are even allowed. So that's kind of another thing to think about when talking about like owning Lido based assets, is there's not going to become less ST-ETH until like at least 6 months from September. And I would imagine like, I mean, I don't know. It could be fully 12 months or it could be more. So yeah, there's kind of this grace period of like, this protocol can basically only grow for the next, at least in terms of ETH denominated, it can only grow for the next year. So looking at other like mature staking protocols, like layer ones, kind of like trying to triangulate a little bit like how big of a boost we might expect. The average amongst like the major players is like around 50%. There are some that it's like as high as 80, some that are like, more like around 30, 40%. But yeah, so there's sort of definitely, I would imagine, I think there's every reason to believe that it's kind of in everyone's best interest that the staking ratio, meaning percentage of total ETH staked, grows by some multiple, which could be 3, 4, 5, 6x what it is currently. So kind of extrapolating that to ST-ETH, it could grow from 7 to 35 billion, and the like ETH denominated revenue for LDO, the DAO treasury could grow from like 160,000 ETH to nearly 1 million ETH. So yeah, basically the tokenomics for this system are, I think, set to change pretty drastically post merge. And yeah, I think this trend feels pretty unstoppable to me, which feels like worth just kind of, when something looks very obvious that it will happen, it's kind of, I think, worth like digging more into like what the inevitable consequences are. So I wanted to just like kind of, if anyone doesn't know what MEV is, it's basically the sort of extra value you can squeeze out of your role as being a block producer. So miners do this right now. And it's like, it can be a little bit pernicious. It's often things like front running people's trades. So if you kind of like order transactions so that you can if you see a big trade coming along, you can kind of like juice a little bit of value out of your role as proposing the next block by basically agreeing to like put someone else's trade before that big trade and after that big trade. And there's like a whole huge world of this. There's a lot of money to be made in doing this, and it's sort of really difficult to stop people from doing this. And so, this is now going to basically become something that proof of stake validators do. So this is going to be something that the protocol now has as a source of revenue. I think right now they're just saying like MEV is going to be restaked, and just sort of like the staking rewards are going to be boosted through that. But they're also, I think, open to doing new things with that, like new source of revenue. So I think there's like some governance proposals that are on the way. Also wanted to briefly mention just that like Lido is expanding multi-chain pretty quickly. So I think like over 90% of their revenue is currently on Ethereum. But this is really interesting. Like 50% of Lido revenue was Terra before Terra blew up. So, it's sort of like, I think, really interesting to look at like, okay, well, actually, like there could be a lot of value capture in moving to these other chains. And I will say, I think like, transaction fees and staking rewards are like kind of one of the more solid sources of revenue in crypto. So it feels like part of the reason why I kind of like chose this asset to present on is it feels like a very like bear market, like very solid kind of protocol for when things are sort of blowing up. Like the Ethereum transaction fees, especially, it feels like it's like a very real source of yield. So kind of some trends to look out for here is like, cross-chain. Is there enough friction between chains that like is the liquidity flywheel that we talked about gonna basically jump chains and be just as powerful? And right now it seems like it's not as powerful on other chains. Like there are, for instance, on these various chains, there's like competitors that are bigger than Lido. And sort of to be determined what the role of like wrapped staked ETH on other chains, like how important that ends up becoming as these like other L1s grow in the coming years. But Lido is definitely like positioned in a really powerful role to potentially like capture a lot of value on these new chains like it did on Terra. And as we saw with Terra, like, 50% of the protocol, like it grew to 2x based on its participation in the Terra staking economy. So, and it's sort of, so it's like if you want to have like a simple strategy holding LDO, there's revenue from the staking economies of all these chains that get compiled or get sort of like aggregated into this one token that gets the revenue from that, which is the LDO token. So, So yeah, like, or
Just
so
a quick
someone.
question for you. By the way, this is such an awesome presentation. Thanks for prepping this. Do you think that part of the reason they haven't been as dominant on other chains yet, like I was wondering recently I was thinking about like where is liquidity pooling, and so like one bit of context I can add there for Lido, I have I have been very surprised they don't have more staked Matic, but then I need to like do a better job of verifying this. I was recently told that like 92% of Matic is actually held on Ethereum, which again
Whoa.
I would yeah, and again could be I haven't been able to like really like confidently verify this, other than like looking at Etherscan and trying to look up some like Dune charts and so on. But anyways, point being, if that is true, or if it's even indicative of all of the Matic that's sitting on Ethereum, you know, I guess it begs the question, like once they launch staked Matic on Ethereum versus like I think it only lives at this point on it mainly lives on Polygon. Like will this flywheel like kick into gear that you've been pointing out? So anyways, if would love if anyone later on can verify this before the end of the call if anyone's
Yeah.
more set with on-chain analytics.
Yeah, totally. No, it's an interesting, like, I really don't know. I mean, it feels uh like to the question of whether this liquidity flywheel is going to, you know, jump chains. It just feels like both DeFi on chains other than Ethereum is just smaller. So I could see where it's not a priority for the team or something to like build up that presence on all these different chains. And then also I think like bridges are still just so just sort of unreliable and difficult to use that yeah, I could just see things changing a lot in the next couple years. So it'll be really interesting to see, like, does this become like a multi-chain kind of monopoly? Other thing that is really interesting, just sort of this upcoming part, we're going to talk about like what does it mean for one entity to control X% of blocks that are produced on a network? And there's sort of a further like part of that question, which is like, well, what if that same entity controls block production to a significant extent on another chain? That there are, I'm no expert on this, but I understand that there are like cross-chain MEV possibilities, which is pretty just like wild to think about, like MEV involving like bridging, etc. So yeah, it's wild, but I guess just kind of the last part of this presentation is like, so obviously there's something really compelling about this sort of like natural monopoly that's formed around liquid staking derivatives, and then the obvious massive growth of staking post merge in Ethereum, and kind of how like Lido is really positioned to capture just a bunch of that. And sort of the other end of this conversation is just like, well, is this a good or bad thing? Not for me as a singular investor, but for the Ethereum community and for just, I guess, the space more broadly. So I grabbed this like headline to start with, which I guess is just sort of grounding this in that like, we just experienced this really crazy moment of censorship of, whether you think the application is good or bad. This application called Tornado Cash has just been sanctioned by the U.S. government, and one of its core developers was arrested. And so this is pretty massive like moment in terms of like challenging like the censorship resistance of the system broadly. And there's been a number of like different actors that sort of like at the end of the day we see that they're again, whether you consider this good or bad, just sort of academically, it's like they're going to play by the rules that are being, you know, forced upon them by one of the most powerful governments in the world. And so one of these is Ethermine, the largest Ethereum mining like cohort, which voluntarily censored transactions going to Tornado Cash. Another one that I thought was really interesting, I had always kind of considered, so there are a number like of centralized RPC services. So that's basically like a service to interact with the blockchain. Like Infura and Alchemy are just traditional companies that run this type of infrastructure. There's one called Pocket Network that is like supposedly a decentralized alternative. And I was really interested to see just like immediately they were like, we're censoring, you know, we're not going to allow transactions to Tornado Cash. So it's kind of this moment of seeing like, and again, I don't want to like really, you know, I don't have like a strong opinion about whether like Tornado Cash is like really great for the world or something, but like it's just interesting to see like who, like what systems really are like permissionless, centralized, and which ones have these kind of permissioned like kind of stop gaps that become visible in these moments. So anyway, like this is, I guess, just to start the argument, like this is where we're at. Is Ether, the largest Ethereum miner, did just voluntarily decide that users can't interact with this one application. So this is a quote from Danny Ryan, who's one of like the Ethereum like big dev people, just saying that like Lido passing 1/3 of block production is like already an attack on Ethereum proof of stake. And so I don't know like too much about this specific like problem, but there's this kind of famous problem called the Byzantine generals problem. And basically if you possess over 1/3 of block production, like it means like you kind of have like attack vectors on the system that are made available to you after having that amount. And then like maybe more importantly, I'm not really sure, but like once you have over 50%, you can kind of really manipulate. If you chose to be malicious, you could kind of fully manipulate like and double spend, for instance, using a 51% attack. So again, I also think it's worth mentioning that like if you look at the top, you know, X number of like mining cohorts that have existed on Ethereum and Bitcoin, like it's not unreasonable to think that like collusion between even just like 3 entities could lead to like over 50% of hash rate on like Bitcoin or Ethereum. And so it's like not like we have this perfectly decentralized hash sort of world right now, and that this is going to like really be completely different. But yeah, it is worth knowing that like that X% of sort of like power over the blockchain is held by X number of entities, and that's like really not an ideal thing for the system as a whole. And so I guess like the idea here, like, and something that I think warrants more digging into is just like, okay, so Lido has the ability to add and remove node operators. So these are the people who actually produce these blocks. And so the argument here is basically if you can choose who you want to be the validator set, then isn't it basically just that you have control over the, like, you're one entity that has control over the block production of that all those people do. Because if you ask them to do something and they don't comply, you have the ability to kick them out. So yeah, it's again, it is sort of analogous to like the mining cohort, where it's like these are a bunch of individual actors, but that are unified by like these sort of like more centralizing governance mechanisms. Another really crazy thing, so the distribution of LDO right now is really lopsided. So this is Etherscan. The top 100 token accounts hold like 92.32% of LDO tokens. So that means like 100 entities max. It could be even less than that. Hold 92% of the governance power of this token. So I guess putting this all together, or sorry, this is someone. Sorry, I heard someone, I think, trying to talk. So I guess like putting it all together, the sort of like dystopian case here is that like these 100 entities control Lido and use that power to basically install sort of like a group of validators or block proposers that that are friendly to their aims, and that oligarchy, like the Lido sort of oligarchy, controls like greater than a third of blocks or greater than a half of blocks produced, which leads to really negative outcomes around like sort of unlocking new levels of MEV, and that like oligarchy basically becomes a single point of failure for basically colluding to push Ethereum in a specific direction, and for like censorship and favoring and etc. of new applications, certain applications over other ones. There's, with that amount of power, there's like kind of a list goes on around what could be done. So then I guess the other, or sorry, this is not. My PowerPoint does not want to. Oh yeah, here we go. So the other side of this is, and I guess sort of like the argument for Lido. One thing is just like liquid staking in general lowers the barrier for most people to stake, meaning like more people are going to be able to participate in some way in both the staking economy and the governance of block proposals. That like a higher staking ratio in general means better security for Ethereum. That, like I talked about, that basically this situation already exists, and that the incentives are strong enough that to prevent people from colluding. Basically, this argument goes like, if you own 50% of the network, why would you ever double spend? Because sure, you maybe like hack someone for some amount of Bitcoin or Ethereum, but you also like completely devalue the whole system because people lose faith, and you've built up this massive stake in the system, so that incentive is strong enough to keep you honest. And then this is maybe the one I found sort of most compelling, is that if this is like a winner-take-all market, and there's sort of no avoiding like a major player controlling most of the market, that the Lido team specifically has shown themselves to be like really dedicated to remaining decentralized. So that's obviously not like a super like ironclad situation. But I will say, if you read at least their material, there's like a lot of things that they're putting in place that are attempting to deal with this. Although I will say this is a very like big problem. This I thought just was interesting. So I think there's a lot of comparisons you can draw between one-to-one pegged liquid staking derivatives and stablecoins, especially like Tether and USDC. And this is just a graph of the change over time of like, well, yeah, there's like liquidity. There's very similar, I would argue, like liquidity flywheel effects for stablecoins, where you really only want to hold your stablecoins that are well integrated. They become more valuable when they're well integrated, and so new users choose to denominate in the one that's most integrated. And like that's very true for stablecoins as well, although we've seen USDC like really take over a substantial amount of market share from Tether. So I think this sort of to me indicates that like maybe this is just sort of weirdly a blind spot where there just hasn't been enough force from teams that are looking to build out like liquid staking derivatives, or enough funding potentially, or that just like there haven't been as many like strong competitors as sort of you would think, and it's sort of like a market failure or a temporary market failure. I will say personally, I'm interested in like I would be interested in talking to teams that are looking to break into this market. And so I want to continue on that point in a little bit, but one thing to just talk about is kind of like reading into some of the governance changes that the Lido team is talking about. So one thing, and I'm not sure if this is passed already or if this is in the works, but they're talking about like expanding governance to include STETH holders that basically have like a veto power. So there's sort of going to be like a checks and balances system where if LDO holders want to do something that's sort of bad for the Ethereum economy broadly, that like people that hold STETH would be able to vote against that. So if you read the blogs, they're talking about basically trying to scope down their governance abilities to like very, very minimal power. It's hard for me though to like imagine that, like I don't know how you truly decentralize the validator set, like because yeah, I think I mean it's interesting. So, but they're talking about different like constructions around like grouping validators and yeah, sort of like more advanced ways of selecting and having validators like check on each other and stuff like that. And then like removing some amount. Right now, this is just like peer reviews. So it's just people in the DAO sort of like writing like, oh, I think these validators are good for this reason. And they're talking about basically trying to automate that. So it would be like a way of being more data driven and objective about what is a good node operator. So it's like an interesting, like challenge and path. I mean, it's very, I think it's really difficult because it's like, that's going to change so much. It's not like what a good node operator is now is necessarily going to be what a good node operator is in 5 years or 10 years. Certainly things are going to like change, and there's going to be like debate over, you know, the future of how the whole system works. So it's like, I think it's like coming from a good place, this idea of like, well, we're going to write rules, you know, sort of programmatic rules for what makes a good node operator, and then the system can just approve new node operators, and there's no sort of like oligarchy there because there's no like committee of powerful people who are just saying yes and no. based on like who they like or who they think will collude with them. The problem, I think, is this: any way you write that, that like automated scoring mechanism is going to have to change, and then it kind of just becomes like one step removed of like, yeah, maybe you're not just directly picking node operators, but you're like writing the code that scores them, and of course there's like inherent sort of like power in doing that, and so it's like maybe it looks a little bit more fair, but hard to tell if it is. But yeah, so I guess like the sort of like good path here, I guess, is like the Lido reduces scope of the governance basically over block production, and that there's like meaningful competition from some other entity or entities, that like block production becomes at least like, you know, somewhat decentralized, and that there's like, we can of course have like the yeah, we can rely on honesty through the way the system's designed to work, which is having like a distributed set of people that are producing blocks. So yeah, kind of wanted to come back to this idea of like these liquidity flywheels, and how, to me, there's like a there's a comparison to be made with stablecoins, and sort of like how we saw that work out with stablecoins was like the curve wars basically. And yeah, I think there's like a possibility and something to like kind of look out for, I would say. And I would mostly say like after the Shanghai upgrade and withdrawals being enabled. But just that like we may see like a similar situation where new competitors seeking to break the liquidity flywheel effects of the people they're competing with start offering like rewards on certain exchanges, and bribes for voting, you know, for gauge voting, like we saw with the curve wars. So because this is, especially after the Shanghai upgrade, when there's the one-to-one peg that's double arbitrage, like I think there's a possibility that we like see similar dynamics evolve around liquidity for liquid staking derivatives. So that I thought that was like an interesting idea, and I don't really see that happening right now, but it's something. Again, if anyone's out there interested in sort of like pursuing some of these ideas, I'd be interested to talk to people. But I see this as maybe something that happens after Shanghai. So yeah, parting thoughts, I'd say like LDO seems really compelling to me. Definitely do your own research about all this stuff. And I would also just say like we're all Ethereum community members, and so we should be really concerned. You know, just as people who love like decentralized systems and censorship resistant systems and etc., we should be really concerned about these like critical points of control over block production, which are I think pretty clearly, I mean, Lido right now has like over 30% of the stake on the beacon chain on ETH2. So you know, we're around these metrics right now. So so this is like something to really like think about if we want to support this, or if this is something that we, you know, we want to support competitors, healthy competition. So yeah, that's the presentation. I'm gonna stop streaming.
Thank you, Tom. So do we have any questions for Tom?
Hey, Tom. Thanks for the presentation. Super helpful. I'm curious if you think that there are other liquid staking options that are interesting or on your radar, just thinking a little bit about how you ended the presentation.
Yeah, I would say the big one seems like Rocket Pool, which admittedly I have not done enough research on, but I've heard the argument made that like their validator set, or the way they maintain their validator set is like a more decentralized approach. I really would need to like do more research to validate that, but I think it is probably worth looking into that. I also think like there's sort of an approach here that I think is just a more like technical approach, like improving the MEV landscape and kind of like at a protocol level trying to just make sure that these more like drastic MEV tactics don't become commonplace. And then, yeah, I mean, the holy grail there, I think, is like the just sort of like reducing the barrier to becoming a node operator, such that like there doesn't exist like a massive power around choosing the validator set. So yeah, but I would say Rocket Pool seems like the one that most people are like more interested in.
Yeah, and from an earlier comment you made on Lido, it sounds like one of the best things they could do, just given already their dominance, is and I don't know how much they do this because I don't really follow their governance process, but being very open, transparent, and formalized to the point where they're kind of almost self-imposing handcuffs on their processes, especially around the ability to kick a node operator out. Is that a formalized process right now? Is that done transparently? Have they done it?
Yeah, so I think also, and this is such a classic thing in this space, is like you kind of are on the one hand are talking about these like lofty ideals, and then on the other hand, it's like there aren't infinite number of groups out there that kind of would even know how to like run a validator, and so and one thing I read, they said like we're kind of running out of like our list of sort of like people who are next in line to become validators. So weirdly, like that is also a bottleneck right now. It's just like there are not unlimited number of entities that even know how to do this.
Interesting.
I
feel like I need to at least pause and let others ask. So I'll pause here for now. Let others chime in.
Yeah.
I'd poke at that even a little bit more. Tom, you kind of made the comment that that you thought Lido was highly dedicated to decentralization and maybe top among that. And I like Linero, I would say I'm not familiar enough to be able to make a call one way or the other. But I've heard the same thing that you have about Rocket Pool and them kind of like starting from a position of greater decentralization. I know that Lido, I've heard them talk before about, kind of progressively decentralizing, and I think that Rocket Pool is trying to start sort of begin from a place of greater decentralization. So, but I want to come back and poke at this, like how dedicated is Lido to decentralization? Because frankly, I don't see that they have a lot of incentive to be, and especially with this complete mess around Tornado Cash, like. It's kind of shocking how many participants in the space end up being not terribly committed to censorship resistance, decentralization, all the stuff that we talk about. So I'm wondering, for Lido, is there do they have like a track record? Like, have they, other than saying that they're like very pro decentralization and like talking about things they could do they have like a concrete track record they can point to for moving in that direction?
Yeah, I really don't know. I mean, I would say the thing that feels most, and they've kind of owned up to this as far as I know, but like the thing that feels most sketchy is just how not decentralized the distribution of LDO tokens is right now.
Yeah.
And that like if you know that basically your, the people that were in your seed round like own 90% of the tokens, I do think like starting from there, it's sort of like, I think you can't act like that's a decentralized governance mechanic, even though it's a DAO and anyone could buy the token. It's like you kind of can't claim that that's like so I think that's kind of the thing that most concerns me. And as far as track record goes, I mean, I think it's like it's a complicated problem they're dealing with, and none of the incentives are there to make them change really, and they're sort of writing about wanting to, but I don't know. It doesn't feel especially like
Mm-hmm.
It's a tough situation because like on one hand, as an investor, you kind of love it, right? Like you love their monopoly, you love their ability to be very much the dominant player and to create these moats. But as a decentralization Ethereum kind of maxi, you hate it, right? So it's like these opposing forces here, which puts you specifically as an investor and decentralization maxi. It sounds like at kind of gives you a little bit of cognitive dissonance.
Yeah, totally. Yeah.
Have they said anything publicly since all of the Tornado Cash censorship shit started hitting the fan?
That's a good question. I didn't read anything about
like they're not in a position as validators yet, but they're kind of like it's 6 weeks away, right? That they suddenly will be. And so particularly I had no idea about that that Ethermine censorship you showed. That's that is double shocking.
Yeah, this is what I mean by like, it's not like we're at like this. I mean, Ethereum is pretty good, I would say, as far as like most decentralization metrics. But like, there's certain things where you uncover them and you're sort of like, wait a minute, this one entity like controls like that much, of the hash power. Like that is really like precarious. And there's like a lot of stuff where if you dig enough, you kind of like can uncover these things that really seem decentralized, but there's kind of these hidden power structures where you realize like, oh no, there's like not that many people who, if push came to shove, there's kind of like some people could pull the plug. But I mean, we've, so it's unclear. It's like how, I mean, it's really wild too, because I do think, the Tornado Cash thing feels like potentially the kind of first shot in like, I don't know. I've been saying like, oh, they're going to start really cracking down on regulations soon, and it just seems like it never happens. And I don't really know how big the kind of like whole crypto world needs to get before it becomes like existentially threatening, and we really see kind of like big movement from governments or whatever to censor what's going on. But it is, like I said, it's like the Tornado Cash thing, it definitely kind of let you know what parts of the infra truly are decentralized and what are kind of just not. The other one that really surprised me was Pocket Network, because when that happened, I was like, oh, Infura and Alchemy are like not processing transactions to Tornado Cash, like, oh, Pocket Network, like that's the like node infrastructure that is decentralized. So like, oh yeah, they got, and I go there and it's like big banner on their like front page that's like, we've banned like all transactions to Tornado Cash, and it did not seem like it was like a vote. So I don't know, it was sort of like surprising to me.
Well, and it's a brutal precedent, right? Like instant voluntary self-censoring. It's ugly.
Yeah, it's hard to know. It's also, I mean, it's like, like, I think to me the ideal is not necessarily that like anything goes out there. It's that there's like a democratic control process over like what's possible. And maybe Pocket Network, like maybe I just didn't see that there was like a DAO vote, and everyone was just like, yeah, we think that Tornado Cash is not really like, we don't want to be supporting it, and so we're not gonna support it. But it seemed to me from reading the post that it was like, I don't know, some small group of people that just decided it. And so, yeah, I mean,
Well,
also,
and I mean,
yeah,
it's a sovereign, like it's a U.S. sovereign decision as well, right? Like they're not basing their policy on China's opinion on whether they should be operating.
right. Yeah, I mean, it's going to be really interesting to see like what are the things that eventually like, people put their necks out to like risk it for certain things. I mean, like the privacy is like definitely, and it's like the demographics of everything's changed a lot. Like I remember like the early kind of Bitcoin people were so hardcore about like privacy. That was like such a big thing. And I think maybe like kind of some of the new, like since DeFi summer, some of the like newcomers are sort of like, I just want to be able to, access like financial opportunities that traditionally have been like sequestered for this like upper echelon of society. And as long as I can like do that and I have like financial freedom, I don't want to fight for like privacy, which I kind of get. I mean, I get it. It's like this is maybe more impactful to like people's day-to-day lives. But yeah, I don't know. It's interesting to just like, it's hard to imagine less of this kind of, now that this precedent has been set, less of like sort of meddling on the behalf of the US government, probably.
Or any government.
Yeah.
Mm.
Yeah.
If nobody's got anything else, I'd poke at one other thing. And every time I hear about tokenomics of a like a profitable protocol, I always kind of ask myself the question, like, it sounds like there's no like LDO token revenue share. So Lido, the DAO, is just sort of sitting on a rapidly growing treasury. Is the idea that like they just, what's the point of all that, I guess? Is there like a
yeah
why
yeah,
does
totally.
Lido need a giant pile of ETH?
No, totally. I don't know. It's an interesting one because I think, again, as far as like, I mean, the new hot bear market like narrative is like real yield, right? And to me, like Ethereum transaction fees, there's a handful of things that I think are like really, really, really solidly real yield, but transaction fees from L1 Ethereum feel like a very hot source of just like that is people just spending money to use something. And so getting to a point where if the numbers stay the same, owning 30% of all transaction fee revenue from Ethereum, that's like such a big deal. So I wonder if like if we might see something. I mean, I don't know, like it feels too traditional for like a DAO to just be like, we're going to pay, dividends to token holders. I don't know if there's probably legal implications for that too, but yeah, you're totally right. Like they're sitting on this big pile of cash and like, what's it for?
Facebook ads, I guess.
Yeah, I mean, I don't know. I really don't know. But it's like it's gonna grow. That's that I feel certain of. But where that, like, why that would immediately translate into like LDO price going up? Like, there's not a direct claim mechanism. It's not like you can exchange your LDO tokens for a share of that or something like that. So I think it's sort of just like along for the ride, and like we'll see kind of like, to me it feels like very, very like solid design pattern for growing that thing, but where that turns, like where the rubber meets the road for like why that matters, it's like you kind of, I don't know, I think you got to just like be along for the ride a little bit and hope that it will turn into something meaningful. Like, yeah.
I mean, I guess my worry is just that if all those tokens have is governance power, and you're talking about a protocol that has whose like possible power due to their huge monopoly is overwhelming, then I worry that some of your small number of huge token holders find a way to turn their LDO positions governance power into economic power.
Yep.
Right?
Yeah.
Like if revenue, like if they're not incentivized based on like a mechanism that's built in at the ground level, like something simple like revenue sharing, which has all these legal implications, as you say, and that could be more than enough to stop them. But feels like if you have something that you can easily monetize, it's it makes the risk that you do it even worse.
Yeah, I think you're on one hand looking at the ability for a small group of people to vote themselves a share of that treasury, basically. But I think that does get that gets countered because they are so big. If we're still looking at the implications of whether or not it's a security, it will be organizations like Lido that really get the first look.
I don't know, Linera. Like the way I see it, voting to give themselves a share of the treasury is kind of like the best case scenario. Whereas if the main power that your token has is that you have governance control and you can start to play games on validator selection and rejection, and like it's that pernicious kind of that Tom was talking about earlier, prioritizing one over another. It's the double spend attack. I agree, always seems sort of unlikely because you're shooting yourself in the foot. Yeah. But there are ways to wield that power, right, to sell something that you shouldn't really be selling. And it seems to me like, the revenue that Lido sits on and they want to share it with their token holders, despite the fact that the token is not well distributed, that's kind of like to me the best case way to it's like the best way for LDO holders to monetize their holdings.
Well, we love real yield, so we would love it.
We do.
That's for sure. Actually, I've just never paid attention to their governance process, to be honest. I think they've always been in the background. I've always taken it for granted that they're doing, quote, right. But Tom, you've got me really thinking about that now.
Yeah. Yeah. Well, I have to jump, you guys, but yeah, thanks for being here. This was really great, and definitely feel free to, message me directly if you want to continue this conversation. It's one I'm definitely like thinking quite a lot about right now. So, yeah.
Thanks for doing the presentation. Really informative.
Yeah, really, really great, Tom. Thanks.
All right. See y'all.
Yeah.
Cool.
Thank you, Tom. Very insightful as always.
Yeah, no problem. This was really fun. It was really great to have an excuse to just kind of do a deep dive. So, yeah, and see you guys soon. All right, take care.
Talk soon, Tom.
Take care, guys.
Thank you. Thanks, everybody.
Thank you.